Hello, welcome to Accounting Hub. I'm Professor George Carpin, PhD in accounting, and today we will be talking again about financial statement analysis. And our topic today is solvency ratios. Another way to measure the company's risk. So, first of all, we are working with Coca-Cola financial statements. No classified info. All of our info, they are on this link here. Uh, if you want to go there, just write this link, or better, go to our video description and the link is over there. Okay, so they are public info, so no classified information here. I only copy this number and paste on an Excel file. Okay, so let's go. Solvency ratios. We have two ratios: debit to equity ratios, total liability divided by stockholders' equity. That is the most important ratio for capital structure. We compare, okay, where our funds came from, either liabilities or stockholders' equity. So, which one is the largest one? Our company is financed by liabilities, so by creditors, or by investors and earnings, stockholders' equity. And the second one, we are talking about interest expense. Okay, is the interest expense, are they huge or are they a small number? So we compare the income before interest expense or net income plus interest expense plus tax expense divided by interest expense. And by the way, the debit to equity ratio, there are some textbooks that they provide another ratio called debit to asset ratio. That is total liabilities divided by total assets. Not so often, but you can see it. And the ratio, the number will be different. However, the interpretation of it will be the same. Okay? So let's go to our Excel file here. And by the way, we have four videos about financial statement analysis, vertical and horizontal analysis. That is the vertical and horizontal analysis here for income statement and for balance sheets. A second video about liquidity. It is here, liquidity. And then this video, solvency, and another video about profitability. Okay, so all of our four videos, they are in the same Excel file. Okay, and usually we work with 3 years of data. For instance, here 2019, 2018, and 2017, and 2 years of ratios. Why? We don't have it here, but for instance, liquidity, there are some ratios that we work with average numbers. So average numbers, we need the third year to calculate the ratio for the second year, because the average is current year plus prior year divided by 2. Okay? And here, this picture here, I only copy and paste from our PowerPoint. So we don't need to move our screen a lot. And it is easier if you are only with the Excel file. Okay. So debit to equity ratio, total liabilities, balance sheet, liabilities, total liabilities, divided by total stockholders equity or total equity here. 3.55. We have much more liability than equity for Coca-Cola. So Coca-Cola is a company that deals much more with liability than stockholders' equity. We have a problem here. We cannot copy and paste this formula. Why? Because the next row is not the 2018 numbers. It is the vertical analysis. So we need to calculate it Again, 2018 here, total liabilities divided by total equity. And what is our interpretation here? Oh, oh, oh. Coca-Cola has 3.55 liabilities for $1 equity. So perfect. Oh, and here, this index is the lower, the better. Because it is not good to have a lot of liabilities here. So the lower, the better. And let's do this for the equity as well, or uh, for the liquidity. So let's do it better, just like your file now that is here. And receivable turnover, average collect period, the lower the better. Average days, the lower the better. And here, the greater the better. Okay, wow, that's beautiful now. Okay, guys, so Coca-Cola has 3.5 more liabilities than equity. And then the second one, time interest earned ratio. That is net income plus interest expense plus tax. So first of all, we don't need to do everything. So net income before tax. That is our net income plus tax. Plus interest expense. However, interest expense is a negative number. So to make it positive, to sum it, we need to put a minus here because minus a negative number, same sign as here, so we have a plus. So less interest expense divided by interest expense. We don't want a negative number because we don't have a loss here. So divided by negative interest expense. 12.41. Let's do it for 2018. Net income here. Oops. Net income before taxes less interest expense divided by negative interest expense. Oh, let's do the same here. 31 instead of 32, then we have the total. Uh, what do we have here? Okay, we have a lot of liabilities. However, we are we have a lot of money to pay our interest expense. So the interest expense is not hurting our income, and it is better now because this ratio here is also the greater the better. And how do we know if it's the greater the better or the lower the better? Look at our denominator. Let's talk about good and bad guys. Equity. It's very good to have a high equity. So the index is the lower the better. Interest expense is not so good to have a high interest expense. So the greater the better. Okay, and let's have these double asterisks here. And Coca-Cola has 12.41 income before interest for $1 of interest expense. This second ratio here, it's not so often to see it in analysis and so on. However, the first one is one of the most important ratios of financial statement analysis. Okay, guys, so thank you so much. Subscribe our channel, like this video, and like our Facebook page, Accounting Hub by Dr. Scarpin. If you have questions or comments, leave it here or email me at jscarpin@gmail.com. Have a very nice day and God bless you.